Imagine that you are a farmer and that in 6 months you will need grain. And that the cost of that grain in 6 months could double or it could drop by half. Nobody knows how it will turn out. Then you go to the supplier and agree that you will buy grain from him in 6 months, but at the current price. If the grain goes up in price in 6 months, you'll be on the plus side, you'll buy it at the old price. If the grain becomes cheaper in 6 months, the seller will be on the plus side. He will sell it to you at the 6-month-old price, which was higher. This arrangement is called a futures contract. Futures trading is not an investment. There are 2 reasons. First, you can't just buy a futures contract and forget about it, the way it works with regular stocks. A futures is a futures market instrument, which means that each futures has an expiration date, a date on which all open contracts are executed, and each party gets some kind of result, profit or loss. Second, futures don't have the added capital that stocks have, which you, as an investor, can feel in the form of dividends or share price appreciation. What are the benefits of futures-free leverage? Leverage allows you to make trades for more than you actually have in your account. No restrictions on short selling. Short selling is an opportunity to sell what you don't have. Cheaper trades. There are different fees when dealing in stocks and you often have to pay the depositary for holding the securities. In the case of futures, the fact that they are not securities, which need to be kept in a special vault, comes into play. The depositary does not charge for such an arrangement. Disadvantages of futures: high risks due to leverage. This is more of a speculative tool, so when trading, it is important to consider technical analysis and place stop-loss orders. Futures have a limited lifespan, 9 to 12 months on average. Futures are not suitable for long-term strategies and passive investments, otherwise you would have to buy a new contract every time it expires. What are the risks of trading in futures? The risk of trading with leverage. Trading in futures allows you to open a position which is many times the amount on your brokerage account. In case of success, you make big profit, but if something goes wrong, the losses are often unlimited. You can lose all the capital. It is not possible to sit out losses, as in stocks. After all, futures have a short lifespan, and variation margin is deducted from your brokerage account the same day, and you may need to add money. Changing the risk rate. When the market is stormy, the exchange may raise the margin. If there is not enough money in the account, the broker may force a position in the portfolio to close in order to make up the cash balance, which is called a margin call. Low liquidity. Some contracts may have low trading volumes. In this case, it is difficult to enter or exit the position at a fair price. And so, what can we conclude? Futures are not for investors, but for traders. It is a derivative financial instrument which does not give any rights to the underlying asset. Futures are suitable for speculation. They allow you to use the leverage for free and are cheaper than similar transactions in shares. There are settlement and delivery futures. With settlement futures, the financial settlement of your position takes place on the settlement date, while with delivery futures, the purchase, sale of the underlying asset takes place on the settlement date. The price of the futures and the price of the underlying asset are different most of the time, because the price of the underlying asset is the price now and the price of the futures is the forecasted price of the underlying asset later.